Hello, everyone, and welcome to another Top Agent Nation Commercial Wednesdays. Very exciting again, as we're really back into and almost done with the first year of January. And hopefully, everyone's still not on vacation mode. I give everyone till half the year, mid-January, to still come back, be on vacation mode. But I hope everyone really starts getting and planning and executing on what they're trying to do for this year. So, as you can see, a lot of things from last time: tax planning, how to plug in to build your network, to, hey, what's going on in the 1031 exchange world, DST? Because I know, and we all know here, before COVID and then after COVID, right? We got COVID, which changed the game for a lot of people. The interest rate hike really changed it for people because it really made a lot of deals upside down, very hard to deal with. And then going forward with just different policies. And then we thought after the election, tariffs hit us, right? We thought, okay, we're going to do business. Then tariffs hit us. And then a lot of clients pulled back and said, hey, we're not doing anything. And everyone's been praying and hoping ever since the interest rate spike in 2021 and 22 that rates would start coming down. And we're seeing some of that happening now. And for many of us, we hope 2026 will be a fantastic big year. But I'd love to share with our guests to give everyone insights. And even right now, Tommy Thompson just sent you a referral with somebody at DST, right? The game is back, the business is back. So we hope people are taking their mindset back into not vacation mode, but work mode for 2026 and make it a great year. But I'll start with you, Tommy, since I called you out. If you don't mind sharing a little bit about yourself and your company, and we can go from there.
Yeah, thanks, Jim. Great to be back. See a lot of familiar faces on here. Hey, Max, see Max on here. Yeah, Happy New Year's, guys. Off to a running start here. I'll let the rest of the guys here, Justin and Tommy, kind of maybe chime in a little bit. Justin, Amos is probably going to know really well just kind of how the year is starting off with 1031 volume and things like that. But we're seeing a lot of volume already on our end. A lot of people hurdle tax years. They either want to close last year for tax purposes, or they want to close, in the first part of the next year for tax purposes. So usually see a lot of spill off from closings from last year. But if you guys don't know who I am, my name's Tommy Thompson. I'm Southeast Vice President of Fortitude Investment Group. Fortitude is a private wealth management firm, and we specialize in that life after landlord kind of area of the 1031. So for people that want to sell, don't want to manage properties anymore, they can go into something called the DST, Delaware Statutory Trust. It's a security. It's essentially securitized institutional real estate. You can buy a slice of the pizza of a large institutional property with one of the biggest sponsor companies out there in the driver's seat managing that property for you. So if you have somebody that's selling a $10 million property and they don't know what they're going to do if they sell, and it's their grandfather's property or their dad's property, they're older, they don't want to manage anything anymore, but they need the income, and their basis is essentially zero. That's a scenario that we work on, all the time, kind of like clockwork. So we can help you get a transaction done, kind of show that carrot on the other side, life after landlord, and we hope you can close some deals using these tools. I have some slides and stuff, Jim, but I was just doing my kind of elevator pitch there. Just let me know when you want me to bring up some of the other stuff.
Thank you. Yeah, we'll just do kind of intro. And Tommy, thank you, because I know you did my families. They love the cash flow that they bought. And obviously,
they got a great portfolio. Yeah,
that was a nice portfolio. And also, ease of management from the exchange, plus also, some referrals already. So this is exciting. Tommy Brachey, if you don't mind sharing, because I know you have another exchange product. And this is the thing where we're giving everyone a variety, different type of concepts, ideas. And I always say, you always want to try to double end and maybe find the exchange property, but you do need a safety net just in case it doesn't work out. There's an option, right, that your client likes that they can exchange into. So, Tommy.
Sure thing. Yeah, we got two Tommies here presenting 1031 options. I love it. Just like in Nashville, right? Yeah, so my name's Tommy Brachey. I travel the country putting on 1031 exchange education as well. I also educate on self-directed IRAs and solo 401ks. But the reason I put on the education is, for me, all roads lead to transacting in mineral rights. which some of you may be already aware, but for those of you that are not, mineral rights are considered real property in the United States or deeded real estate, just like your house, whether it be a residential home or raw land or a commercial building, like an office building or a Starbucks, what have you. So given that mineral rights are 1030, or excuse me, are real estate, they are 1031 exchange compatible as well. I make a joke in my classes that if you're a recovering landlord, tired of dealing with the tenants, the toilets, the trash, the maintenance, the insurance requirements, the other liabilities, the cash calls, you get it, right? Mineral rights offer you the cash flow without the headaches, none of those things. Not to get too into the weeds, but in Texas, there's also no traditional property tax on mineral rights, even though it is deeded real estate. There is ad valorem, but I'll leave the weeds there. So similar to a DST, we can kind of deed down to the penny, so to speak. So if you wanted to do a full exchange, whether it's 1 million or 10 million or what have you, you can do that. But if you have, and this is more common in the commercial transactions, that just say it's a $10 million exchange and $8.9 million is spoken for another replacement property, you might not find something at that $1.1 million and 10 cents price range that you find savory or something that fits your buy box. I can deed down to the penny to make that your second or third property in that exchange and optimize you from a capital gains tax exposure perspective. But again, I could get into the weeds, but that's a 30,000-foot view for you guys.
Tommy Brachey, thank you. And I love you brought it up because we don't want to paint food. Sometimes you need to put the right pieces together. And Justin, right? I mean, that was a perfect segue to you to call out as you educate people on the exchange, educate people not to pay booed and follow the rules. So if you don't mind, Justin, kind of introducing JTC and yourself.
Yeah, no, thank you very much, Jim. Always a pleasure to speak with you and the collective Tommies here on 1031 exchanges. I think what I've been loving over the last few years is seeing the evolution or the more adoption, I should say, of the 1031 exchange. Even though the exchange has been in the revenue code for well over 100 years, we're starting to see a lot more creative solutions that they don't have to just be siloed into either a DST or mineral rights, or we're seeing different types of land products come to market. Institutional players, REIT sponsors have historically just been in the REIT space are now starting to develop different 1031 products. So it's really starting to bring in institutional money and people are starting to get it. But that doesn't mean that everyone understands it. And so a lot of my job is educating not just real estate professionals, investors, CPAs, some certain CPAs, attorneys on the benefits of a 1031 exchange, how this could be applicable to their clientele, and ultimately develop a long-standing estate planning. So JTC, we've been the exchange business for now 21 years. We were founded on this principle, or this idea that there are these certain investment programs that either lack regulation or compliance guidelines, and therefore fail to fraud and mismanagement. What I like to say is JTC is a tech company with a financial services background. We build purpose-built solutions to streamline the administrative requirements for these specialty types of products and ultimately adhere to the utmost in compliance, transparency, and security of people's funds. And so my day-to-day is working with individual investors, 1031 sponsors, and also aligning our solution with people that deal in the exchange space, but maybe don't want to build out a 1031 exchange team. And so it's definitely a smorgasbord of people that I get to work with on a day-to-day, but I love what I do.
And Justin, since I know it really starts with you without going so much, but maybe high level, or if you have slides and you can run through it, is, the exchange. And obviously you brought up, it's a 1031, it's in the IRS tax code, but there are rules prior to closing your deal. And oh boy, do I hate when people close their deal. It goes, what do I do? Nothing. It's too late, right?
Yeah.
So Justin, high level, if you don't mind sharing this, and we'll kind of go down with everyone else with the 1031 rules to follow and different exchange without, boring too many people that may be experts or did a lot of exchanges.
Yeah, actually, I do have a quick slide that I wanted to share. It's kind of just the key 1031 exchange guidelines. So let me bring that up.
While he's bringing that up too, is, for everybody that's on, if you're talking to clients about this, it's like, I always use the line, guys, this is something that's been around for 100 years, over 100 years as a part of the tax code. So this isn't some weird tax loophole. I mean, this is something that has been used for over 100 years. So that's how powerful it is.
Yeah, and then really it's only changed in its 100 years once, and that was in 2017 when the Tax Jobs and Cuts Act came out, eliminating personal property and focused solely on real estate. But like Tommy mentioned, it's something that's been around, and we expect, within the FEA that JTC is a member of, we expect it to continue here on forward. This is just kind of a visual diagram of kind of the key exchange guidelines for you as an investor or you and your clients to think about. As Jim alluded to, one of the most important things to do is, first to highlight they're both relinquished property and the replacement property have to be properties that were held for business or investment use. That is the statute code that the IRS has given us as a line for facilitating a 1031 exchange. Our role as the qualified intermediary, what JTC provides in this 1031 exchange service, is the integral point of facilitating from the sale and the ultimate purchase of the exchange. Contracts have to include the appropriate clauses, so that way when we can take full assignment of that contract, we can authorize that it is a facilitation of the exchange. But most importantly, you need to get engaged with a qualified intermediary prior to the sale of the relinquished property. If you engage us a day after, or even sometimes on the day where it's on the same day where it's past the recording period, it would be considered a failed exchange, and you can no longer take the benefits of the transaction. I always love to say, and where Tommy loves to say, when you see the time clock, 6 months is how long the IRS has given us to facilitate an exchange. But starts on day one. You hear about day 45 where you have to identify. Love working on day zero. Start as soon as you're thinking about, and right now we're in that kind of cusp of, in January, at the beginning of the year. As Tommy mentioned, we have some bleed over of people who are evaluating their options and now kind of think of what am I doing for my tax year this year or with our portfolio. That's the best time to get in front of your either tax professionals or your qualified intermediary to evaluate the situation and then help you kind of help guide and put you in front of potential opportunities that will help you complete the exchange. And so I'll stop sharing here, and I know others here can kind of talk about
And Jim, do you mind if
solutions to help.
do you mind if I jump in on that
No,
really quick?
please,
Share my
make it
screen.
interactive. Yes, please, Tommy. Team.
Justin, I need to get this to you too. I think Tommy, I was going to get this to you also, but guys, this is a really good piece here, and you can just create this yourself too, right? You just ChatGPT or Google federal holidays, right? But I love this piece because one, it's going to educate you on some the basics around the 1031, right? You have the closing date that your closing is going to land on. You have your 45-day expiration or identification period, and then you have the 180 days, right? But when you're doing this, if you want to seem really high level, for those of you that are high level, tell a client, hey, Mr. Client, you close on this date, okay? But your 45th day lands on New Year's, or your 45th day lands on, a federal holiday, any of these federal holidays here. And you're telling them that because you're saying, hey, we might lose a week, or we might lose a few days, or we really don't truly have 45 days. If we're going through Christmas and the holidays and New Year's, you have less than 45 days. You have probably 3 weeks less or 2 weeks less than 45 days. So a lot of people, they close and they go on vacation or they disappear for a week or whatever, because it's tough to close a property. It's stressful and whatever and all this stuff. So we see it happen a lot where they leave for a week, but then they get back and they don't realize they're also losing another week because it's a holiday week on their 45th day. So I love this piece here because it kind of shows that you're a real expert in this. You're really thinking through this. It's not just about their closing date, but it's also about their 45th day date that falls on as well. So this is a great piece if you want to kind of set yourself apart and try and win some 1031 business. Having some ammunition like this is going to set you apart from other agents that are out there.
I completely agree. I say in my classes too, it's the IRS doesn't care, right? It's if it lands on Christmas, it lands on Christmas. I'm usually dealing with the 45-day time clock as opposed to the 180, but it applies to both, like Tommy Thompson said. If it lands on Sunday, it lands on Sunday. If no one's there to take your identification, that's your problem. The IRS does not care. But with that being said, it was mentioned earlier by Justin, let's start at day zero. I couldn't agree more, but the seasoned 1031 exchangers, if you will, they start before day zero. They're looking at replacement properties before they even begin the exchange periods themselves to give them enough runway to buy them extra time, so to speak, not every transaction can have that luxury, but if you do, it would be wasteful not to go ahead and lay the groundwork before the 45-day clock even starts.
Yeah, Tom, we have clients that are so buttoned up, like you said, the experienced ones, they'll close on day one and maybe 5 days later, they're closing on their replacement property. There's
Slam
no,
dunk.
as long as you're not, you can technically, a seasoned investor, you can be under contract for the replacement property as long as you're not closing on it prior to the sale. And that's a whole
Right.
other mixed
Right.
bag of 1031
We'll go
exchange
into the
transactions.
reverse too, Justin.
Yeah, exactly.
But
Yeah,
Max,
yeah.
go ahead, Max. I thought you raised your hand. Go ahead.
Max, you're muted there.
You're muted. And I know Glenn has probably a question. I see him out, so it's good to looking sharp always. Max, go ahead. You're muted. You're muted, Max.
Yeah,
There you go.
Justin presentation, he was saying something about the cooperation agreement to sign. What are you referring to?
Oh, so great question. So it's the PSA. They're usually there's typically most contract agreements have just template 1031 exchange agreements saying that the buyer and the seller
Oh, okay.
agree to the principles of the exchange. It just has to have some general
Got
language.
you. Yes, sir. Thank you.
Yeah. And any other questions before we kind of move on? Any other questions, ideas, comments? But I kind of love this that people do it. And even Tommy, when I was doing the exchange with you and Justin, the exchange and your team, you do need to have people you trust that may, I'll tell you, go a little extra for you if you call, right, to help you out. Because I know if I didn't have someone strong in fidelity, they closed without the money being wired, that it was in transit, some glitch. They still told title and everyone to close for me. That's a big deal, right? With all these mechanisms in exchange. And unfortunately, I was on a holiday at last minute, freaking out, calling and asking for favors. That's why it is important, not just I know somebody knows somebody and they may not care as much, but there are people that they're kind of in the mix in your team that really needs help. So it is so important to be part of the team. But I'll tell you this is the best thing. These groups of professionals hears and talks to so many exchange buyers. Sometimes they doesn't fit what they're doing or where they're exchanging, and they can open you up. Maybe you have an off-market deal. Maybe you have something else. Is to let them know. We hope with the technology we built is to start matching up more deals, right? Because we want to serve our clients the best to exchange into what works and also diversify into maybe minerals and DSTs. And I love doing this because I'm always learning from each and every one. But Justin, you want to kind of go a little more in the weeds of what you're seeing currently in this market and going through 2026?
Yeah, no, I mean, so, I think JTC has a unique position for where we sit being kind of a global company. So in the weeds of both kind of a national and a global footprint, we're seeing, exchanges and inquiries on different types of exchanges grow. So, I mean, people looking to expand, either take their money outside and invest or they already had investment properties looking to do foreign exchanges. We have a platform to do that. But I mean, taking the DST and the industry as a microcosm to how the industry is growing or more exchanges are starting to hit it hit the volume last year. I think equity raise was close to about 9 billion or 8 billion. So and that's and put that into perspective, in 2021 2022 when the volume was flowing, that's when we got to our heyday, and that was about 7 to 8 million, 8 billion worth of equity being raised into these products. We had it down to in the last few years prior, it was about 4 or 5 billion that was being raised, and so now we're that reaching that 9 billion, and this year is expected to eclipse that. And I mentioned that earlier on, more and more products are starting to come into the market, so that gives a lot of people the opportunity to diversify. But the topics of conversations that we're having, both with financial advisors, real estate professionals, CPAs, and attorneys, I think it bodes well. The pipeline is definitely building. We're definitely seeing some bleed over from last quarter into this. But I think the conversations we're having now is, what can I do? I have a portfolio. I'm looking this is what I'm planning to sell it this year. What options are available to me? What different tax strategies do I have? I think right now is a really great time to exchange because there's a lot of optionality for these exchangers and buying. Just the traditional real estate, the hard real estate. There's passive, there's a lot more flexible options. Even with interest rates as to what they are, that you can get creative to offset the debt that you're needing to replace in the exchange. So you don't necessarily have to have it. Either you can do it non-recourse, you can have it recourse depending on ultimately where you sit in a financial position. And then different types of strategies. We briefly touched on the reverse exchange, the improvement exchange, or build to suit exchange. People are looking into a lot more different options, and getting to educate people on the different options that are available to them, not just what they know of selling and buying from an exchange perspective. So I expect 2026 to be a good year another good year from an exchange perspective, and excited to see the industry grow and as more acceptance.
And Justin, I love kind of hearing that because of such pent up demand. And we know if you're exchanging, there's obviously velocity activity. Can you just share quickly, and then I'll go to Tommy Brachey on this because I want to actually know more mineral rights and stuff, and then Tommy Thompson on kind of cap rates, where numbers are at. But where are the hot spots, Justin, as you see where the exchanges are coming from, from where people are selling to where people are buying or exchanging? Or is there some large red marks that says, oh, they're selling from this state to go to this state, for one, and there's changing from this product to go to another product? If you can kind of share that.
Yeah. So I would say, California always ends up being, so California is a weird one. California, there's definitely a lot of people who are exiting California and moving into, the Southern Belt states. I think that's a pretty, or Idaho, or just kind of some, Midwest type of products. But we also have a lot of people investing in here. I think, some of the things that people don't understand with the exchange, especially from a business perspective, is that you can use the proceeds to grow your business or evolve your business. So we see people even using the Bay Area as a small area. Perhaps Oakland is one of the areas that is becoming more a popular places for people to invest into. San Francisco still as a popular area, even though it's a high income tax state as we are. We're expecting, upstate New York as another area of a lot of investment that people are starting to look into. But then you have your traditionals, your Floridas, your Texases of the world. Tennessee is another market that's been pretty growing, and Atlanta, Georgia is another one as well.
A lot of typical stuff, right? From certain states, not business friendly to business friendly. So actually kind of going, Tommy, Brachey, on because you're in Texas. So
Right.
obviously you see a lot of flow, but also you have a very unusual exchange where not everyone understands mineral rights. So can you go a little deeper into how, what is this that you're kind of proposing and helping the clients exchange into?
Yeah, yeah. So, a lot of people that, are formally educated in real estate, because there's so many lanes, I'll say that first, within the real estate game or the real estate market, if you will. Most people, when you say real estate, you think of what I refer to as traditional real estate, whether that be residential or commercial or raw land. But even those like myself, like I have a degree from the University of North Texas in real estate, and I'm also a licensed agent, advisor vice president with EXP Commercial as well. So I took the real estate license here in Texas. I say that just because despite all of that formal education, mineral rights are essentially a footnote, if maybe only even in the glossary, right? I could say the same thing about 1031 exchanges as well. And then separately from that, this is not my wheelhouse, but air rights are also deeded real estate in most parts of this country too, but I'll leave that alone. But I say that just to say that it's still real estate. It's just not your stereotypical flavor of it. So what I do is probably 80% education based around the exact question you just asked me. So what it is, it's the subsurface estate. Technically, it's deeded real estate. Now, like in traditional real estate, it's all about location, 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 right? No disrespect to anybody living in, say, rural Kansas, but your price per square foot or square mile or acre in that market is not going to be valued the same, most likely, as, say, Manhattan, right? So the same is said about mineral rights. There's a formation underground called the Permian Basin, right? that's in West Texas and part of southeastern New Mexico. It's the highest producing oil basin on Earth. It's not the largest basin, but it's the highest producing. And just as a caveat, shameless plug, I suppose, that's where most of my properties are for that reason. But I say that just to say that that location is going to be much more expensive than places without oil reserves or without other rare earths and minerals, whether it be lithium, gold, what have you, right? So the way that it works is, let's just use the Permian Basin. You got a prop mineral rights in West Texas for the sake of example. You're going to have the big players out there because it's the highest producing basin on Earth. Big players meaning Exxon, Chevron, Conoco, et cetera. So the way that it works is I use a lot of landlord and tenant metaphors or analogies to explain it in my classes, because even if you're not a landlord, you've probably paid rent in your life and you understand the mechanisms. So think of yourself, if you own the mineral rights out there in the Permian Basin and Exxon's drilling on it, you can think of yourself as the landlord for the sake of the metaphor. You can think of Exxon as the tenant, and you can think of that monthly royalty check you get every 30 days, kind of like rent. Except the caveat here is you have nothing to manage, right? You don't have to manage Exxon. I make a joke in my classes, Exxon's not late on their bills. If they are late on your bills, we probably have an existential issue, right? But joking aside, that's essentially how it works. You get direct deposit every month directly from what's called the operator. I try to avoid industry terms, but that's simply Exxon or Chevron, whoever's drilling on your particular property. Now there are differences. Like I said, you have no liabilities, you have no maintenance requirements. You'll never get a cash call as a mineral rights owner. That's all absorbed by the operators themselves and their investors, right? That's a 30,000 foot view of it. It's one of those things where, from a real estate perspective, it's as passive as it gets. I will say DSTs are also extraordinarily passive. They're kind of an exception alongside mineral rights in the real estate game, if you will, in that regard. But what it also comes down to are, in my classes, this might be more information than you asked for here, but I'd like to talk about the risks out of the gate, right? Because it all sounds good. It all sounds perfect. And it is very, very advantageous and it is very lucrative. But it is worth mentioning the risks are primarily twofold. And they're going to sound like common sense after I say it. But one is commodity price. What is the price of oil in my case, for the most part? Also, your natural gas, but primarily oil. Right now, it's bouncing around $62, $63 on West Texas Intermediate, which is a healthy oil price, by the way. Some people have differing opinions based on their own business models. But, with that being said, price of oil goes up, you hold all the variables constant, that month's royalty check is going to be higher than the previous, but it also goes the other way. The same concept applies to risk or variable number two, and this again will sound like common sense after I say it, but it's production volume. In my instances, how many barrels of oil are coming out of the ground in a given month, because you're paid on that. So again, you hold all of the variables constant, production's up on a subsequent month, well, your check's going to be larger, right? And vice versa.
Actually, I loved it. And I was going to ask on commodity price fluctuation, if it's a fixed versus obviously if it goes up, or now with Venezuela, Middle East.
Yeah.
I track OIL. So I like trading and doing stuff with commodities. So it's been a big year for all of us. But do you have to be a broker dealer like Tommy Thompson? Is that structured under what regulations does
Great question.
mineral rights
Great
go
question.
under?
So there's a couple of different avenues in the, I'll just call it, to put it in layman's terms, the oil and gas space. Mineral rights are considered real estate. So given that you do not have, it's not a security. Given that you also, ironically, I'm not saying I have a opinion either way on this. In some states, I think it's 4 or 5 states, you don't even have to have a real estate license if you're exclusively transacting in mineral rights. Texas is one of those states, but I'm licensed anyway, as I mentioned earlier. So as far as that is concerned, generally speaking, you just need a real estate license just to make it say, like, as a blanket statement, just know that there are some exceptions in certain states. Now, there are other avenues in the oil and gas space. I won't get into the weeds on those, but there's like working interest opportunities, wildcatting opportunities, things like that, where you do have to be an accredited investor, generally speaking, to participate in those. But that's a whole different side of the business. That's a higher risk, higher reward side of the business, frankly. But in the mineral rights space, just to keep things simple for your listeners, it's just a real estate transaction. It's just not your common sense flavor of real estate.
Perfect. Well, I did a little wildcatting with a friend on it. Didn't put too much money. You know,
Yeah.
hit or miss. But the chances, if you do hit the right well, I mean, it is astronomical. And I had friends that did it, especially in Texas and Gulf and out there. But it's always interesting for everyone here to learn and understand. This is what makes you a better agent or advisor to your clients. You know it all. And better yet, you know who to go to. So, Justin and both Tommy T, Tommy B, put your information in, because I know they have massive amounts of training classes. And Tommy Thompson, I know you've been doing classes and courses nonstop. Maybe you're grounded more now, more virtual. But can you share on the DSTs where things are kind of at, maybe what cap rates are? And I know everything is not about cap rates, it's risk, it's preference, it's many others. But if you can share what you're seeing with the exchanges of what they're kind of going into, and maybe even talk to the UPREIT, the 721 UPREIT, because a lot of people are now saying, I need more liquidity. This DST is illiquid in a way, mostly. But now a lot of people are starting to say, let's open liquidity for the 721. So, Tommy, if you can kind of share where people are kind of going, what's going on, and tracking what Justin's saying about the volume increasing, decreasing, staying flat, and a little bit about the 721, because I know liquidity is the name of the game to give you options.
Yeah. Yeah. And I'm gonna bounce around a little bit. I'm gonna share my screen on a couple different things here, and then I'll land the plane on the cash flow, kind of cap rate question there, Jim. Yeah, I mean, just from a basic standpoint, if you guys don't know what the DST is, Delaware Statutory Trust, it is securitized real estate, right? So you have to be securities licensed to sell it. So we're a private wealth management firm. You could think of us like a Merrill Lynch kind of, wealth manager, but we don't do stocks, we don't do bonds. We're not sitting down building those traditional portfolios. Everything we do is real estate, and predominantly securitized real estate in the DST space. That's our biggest vertical. So, we're constantly working with real estate brokers, attorneys, CPAs, Justin Amos, QI, on filling that gap on life after landlord, right? I mean, brokers will get these calls. I used to be an agent, cold calling in a bullpen. I used to do net lease real estate. So, I mean, that's how I got exposed to a lot of these 1031 exchanges. And I would get the call all the time. I mean, they'd go, Tommy, I'd sell this Dunkin' Donuts or whatever, but, I don't know what I'm going to exchange into, right? I'm going to have a big tax bill. I don't know what I'm going to do. I'm kind of getting older. I don't really want to deal with this crap anymore. And you start hearing like the same thing over and over. So the DST is one of those solutions. It's completely passive, and it's this right on the side of the screen. You own a slice of the pizza of a large institutional asset, right? And you have to be an accredited investor to invest into them. A lot of people qualify. An easy way to think about this, I'm not going to go through all the definitions of it because it kind of complicates things sometimes, but an easy way to think about it is a lot of folks qualify as an accredited investor on their net worth, especially at that time in their life. Sometimes their investment real estate portfolio is worth over $1 million. So to be an accredited investor, you have to have at least $1 million net worth to qualify to be able to invest into a DST. So if you don't factor in the value of your primary residence, your home, if you take that out of the equation and you tally up your entire financial picture, 401ks, IRAs, cash on hand, and guys, the value of your investment real estate portfolio, which typically that is worth over $1 million in these scenarios, if all that adds up to $1 million or more, then you qualify, right? So that's the DST in a nutshell. I have another slide here that I'll show you guys. This is just kind of on the cash flow thread that Jim was talking about. So this is a new email that we just rolled out. This is our 1031 DST menu availability report. So these are really great. This is going to show you kind of what's currently available on our platform. And we're able to do this now. We used to only be able to talk about past offerings to the general public, but with the addition of 506C products, now we can talk, we can send these general marketing emails out. So this is a brand new DST that just came out, new offering. This is a 4.4% cash flow, institutional grade multifamily property, 264 units, really beautiful asset, 49% leverage. For people that have debt to replace in their exchange, this would be something that maybe we look at if they are open to multifamily, because you get that debt replacement as well when you go into a DST that has leverage, and a lot of people have debt to replace. This is another new one that just came out, 4.3. You're going to see a lot of the multifamilies hovering around that 4.5, number. That's just what it is. Institutional multifamily cap rates are right around the same. So it's going to be a little bit less than what the current cap rate is because there's some fees that are involved with the DST, but it's usually kind of a close strike price to what the trading cap rate is in the market. But then you get into something like this. This is a select service hotel asset in Omaha, Nebraska, right downtown. It actually says United States of America on this building. It's a historic building that was converted into a flagship hotel. But this has a 5.92% cash flow on this and 0% leverage. So kind of just go down through here. This is a really cool deal. Actually, this is the one I was telling you guys about, that Moody deal in Houston. 6% cash flow on that. And then this is kind of a fun one. This is the Ford Amphitheater in Colorado Springs. It's a 99-year ground lease, and it's a 6% cash flow on that. So, just kind of depending on what somebody's looking for, we kind of go through the menu, we tweak it. The minimums in DSTs are $100,000 typically. So, we can build a nice diversified portfolio using multiple of those different DSTs. If you want to log on to see the full menu on our website, you just go right here and you go to 1031zone.com. There's a link down at the bottom, and you can fill this form out here. And if you're an accredited investor, then we get you signed up for it. And then I have the last thing here, Jim, that I'll share, and then I'll hand it back to you guys. Fortitude's done the largest DST transaction in history, so we're the record holder for the largest one of these ever done. So not our first rodeo. When you work with us, guys, we have the process fine-tuned. I mean, it's like clockwork. When you come to us, we have our process. So we want to help you get a deal done. If somebody's hovering and they're on the edge and they don't know what they're going to do, and they don't, they're going to have a big tax bill and they don't want to manage stuff anymore, we always kick it back to you. We just provide the solution and we say, all right, now you have to get the property sold. Talk to Max or Keith or whoever you're working with, and let us know when that's happening. But Jim brought up the 721. Everybody needs to know about this. This is huge. I mean, I've been doing this for 11 years with Fortitude. It's the only firm that I've been with in the DST world. And when I first started, there was nothing that anybody would ever say about 721s. I mean, you would never hear it. If somebody said it, you would have no idea what it was, right? They've been around for a long time. A 721 exchange is actually a way that REITs were able to pull properties directly into a REIT, right? It's a 721 exchange. But you have to own a property that a REIT wants to buy. So they're typically not going to buy mom and pop industrial buildings or, single family residence investment properties or whatever. They want to buy the Amazon distribution centers, the FedEx distributions, some of those multifamily, the institutional ones that I was just showing you, Ford amphitheaters, right? I mean, they want to buy the big stuff. So the workaround to get into a REIT is you sell your property, you 1031 exchange into a DST that is going to get bought by the parent company's REIT, right? And that usually happens after 2 years. Once the parent company's REIT buys that DST that you invested into, you get pulled up into the REIT through a 721 UPREIT, they call it. And it's a non-taxable event, just like Section 1031 has a section of the tax code, Section 721 has a section of the tax code. And you convert your ownership interest in the DST for OP units, you see right here, operating units in the REIT. After typically a 1-year lockup period of being in the REIT, so now you're kind of 3 years full boat, give or take, being illiquid, then you can sell those OP units, or technically you're converting the OP units to shares when you want to liquidate. So you can sell $5,000, $10,000, whatever. So it's a way of essentially kind of getting into the market almost into a REIT in a tax efficient way, and having liquidity. And then when you pass away, or your whoever's the holder there passes away, their heirs get a step up in basis and they have liquidity in the REIT, and they'll typically convert those OP units and sell their shares, in the REIT. But to bring it full circle here, Justin said equity raise last year was like $8 billion. They're anticipating that to continue just skyrocketing and going up. About 40% of that was UPREIT transactions, which is something really, guys, to wrap your head around a little bit, because you will be getting calls from people saying, hey, I heard from my CPA or my attorney or something, like I might be able to sell my property and get into a REIT. If they start saying some stuff like that, just reach out to me, say, yeah, I know a company that can help with some of that stuff. And, we can jump on a call with us, listen in, see how we kind of do the process there. But everybody's different. The stuff, anytime I hear mineral rights and all that, I mean, Tommy probably doesn't even know. I talk to people all the time and I'm like, hey, talk to Tommy Brachey. He's the guy for that. We've all got our niche, kind of area that we're in, and we're just here to help out. We speak on stages together. We've done presentations together. You've got a great crew here, and Jim is the best at putting this stuff together. So, yep, that's my piece there. Happy to answer any questions on any of that stuff. Like Jim said, I do a ton of educations. I do one webinar per month. I've been doing those for like 7 years now on this stuff. And it's really just a tool for agents if they want to invite a client to kind of a nonchalant education on some of this stuff.
Yeah, and then thank you, Tommy, for that. And you think it's boring. You may have kept on hearing this to a certain degree, but it does change. There are new improvements, as everyone said here on the call. You just don't know. And actually, I just learned, Justin, you were talking about a foreign deal. Wow, you know what? I mean, sometimes you do have to keep up to date. Can you share a little on the foreign exchange, since we know a lot of onshoring, but what is the foreign exchange? I mean, I've never heard that yet.
Yeah, no, we posted a piece probably about a year and a half ago, just kind of talking about the foreign exchange, and then we've slowly become the kind of go-to firm to administer these types of transactions. And again, thankfully JTC and their global presence, they have the facilities and our expertise internally to do so. But the easiest way to describe it, when the onshoring, it's domestic to domestic. So, you're selling anywhere in the continental United States or in some U.S. territories. You'll defer the capital gains, but the same applies to if you own foreign assets. So if you sell a foreign asset, whether it's in Europe, working on transaction in Dubai right now, you can sell that property, defer in your U.S. paying tax, payer, you can defer those capital gains that you would assess on owning that foreign asset. And as long as you reinvest anywhere else in the world except back to the United States, because that unfortunately, that what they deem like kind is, foreign asset as, similar to a foreign asset. But it's growing in popularity. There's a lot of, U.S. taxpayers that have owned, foreign investments for many years. That investment is now appreciated. They're expected to face a heavy tax bill, which they don't want to pay. Now you still have to pay in the local authorities potentially some gains, tax bills, but working with your respective CPAs, you may be able to offset that. But at least the U.S. component from a capital gains on the investment property or business use property, you can defer that and continue to roll over. We've seen certain markets like Puerto Rico, Mexico, are becoming a lot more hotbeds for people to reinvest into. So it's been fun and interesting. Each country comes with their closing challenges, but we figure it out one way or another.
Yeah, and I have the foreign question come up very often. I will say this: I've never had a foreign exchange for mineral rights simply because my mineral rights are U.S. based, right? Because you have to go foreign to foreign or domestic to domestic. Now, keep me honest here, Justin, but foreign to foreign doesn't mean the foreign country has to be the same. As a U.S. citizen, you could have a property in Mexico and exchange it for a property in Brazil. But
Correct.
You cannot exchange a property in Brazil to the United States or from the United States to Brazil. So again, domestic to domestic or any foreign to any other foreign.
That's exactly right. Anywhere so if I have the question, people are looking to sell the property here and they want to invest elsewhere. Unfortunately, it can't be done through an exchange. They could pay the gains, take that money, invest elsewhere, and then when they decide to sell later on, then they have the opportunity to do an exchange, but it can't be a direct source of the transaction. But yeah, foreign to foreign will work. So you can go from, like I said, Mexico to Brazil, Brazil to Europe, as long as it's, that property is held for business or investment use, it'll qualify from an exchange perspective.
And then the other niche question I get on that sometimes, so your listeners might enjoy this, is U.S. territories. The exception's Puerto Rico because they have their own tax code. So even though Puerto Rico is a U.S. territory, it is considered foreign for 1031 purposes.
That's correct.
But the other territories are eligible.
Yeah, which is Yeah.
Yeah.
Which doesn't make sense, but yeah. But we did. But yeah, I actually had a conversation with a lady the other day. I mean, because Puerto Rico is a hot market right now for real estate. It's appreciated significantly. So people who have owned properties there, many years are either trying to figure out what they want to do with it. Do they want to keep it or diversify? And that was kind of the Puerto Rico to Mexico question that I had with
Right.
that specific client.
I think Max has his hand up for us.
Yeah, Max. Just unmute yourself.
Muted, Max.
All right.
There you go.
I've got lost when you guys start talking about the foreign exchange. Something I must have not paid attention to. But please, can you explain it in a little bit simpler language?
Yeah. So if you own foreign business or investment asset that's either been rented out or been operating as your a primary business location, a U.S. paying taxpayer, whether that be an entity or an individual, can sell that asset and facilitate a 1031 exchange to defer the capital gains from the U.S. perspective. Again, they'll have to pay the taxes in the local country, that's domiciled. Again, working with an experienced tax professional, potentially you can offset some of those taxes, but then you can take in an exchange, reinvest those proceeds either within the same country or anywhere else in the world, tax deferred through as similar as you would here in the United States. The vehicle itself operates just as the same as it does from a foreign perspective.
So you can bring it to United States? You say?
Cannot.
No.
Okay. Yeah. Okay. Thank you.
Max, it's pretty much the easy way to think about it is like the USA doesn't play in the sandbox with everybody else, but you can 1031 from Canada to Mexico, Mexico to Brazil or whatever, but you just can't 1031 foreign into the US or US into foreign.
Too far.
Yeah.
And the reason being is the IRS views a foreign asset as the term like kind. So it's yes, real estate to real estate, but the foreign domiciled is what really the designator for what makes it like kind from a foreign perspective.
Thank you.
Nelson, you have a question. You're muted, Nelson. There
Hey,
you go.
sorry, I was having a little issue there. So I had two questions, actually. One is in the 45-day timeline where somebody's trying to identify properties, does the DST or the mineral rights offer have to be listed as one of the options, or is it kind of a last minute switcho changeo that you can do within the 180 days? And the second question is,
the fun part about that is, and a lot of people don't realize this, and the guys are kind of, they're going to laugh at this too. It's like, you don't have to have that ID form submitted until day 45. So you're not like submitting the ID form on day 14 and day 20, and you're not resubmitting it multiple times. It just has to be submitted by day 45. So you can swap in and out whatever you want up until day 45. But once day 45 comes around, you've got to have either your 3 properties that you selected if you're using the 3 property rule, or if you're getting a little bit more savvy and you're using the 200% rule and IDing more than 3 properties, you can't exceed 2 times your sale price in value of real estate that you're identifying. So yeah, I mean, you can swap in and out anything. We get the calls, Nelson, me, I know Tommy does too. I mean, we get the calls on day 43. I mean, it's like, and we talked to them about the DST a month ago or a year ago. And, they're saying, hey guys, like, that this doesn't sound so bad anymore. Can we ID it? And it's really simple. So if we ID a DST, it's just like IDing regular real estate. There's an address affiliated with the property, a legal address. That's what we use on there. In our world, it's fractional real estate ownership. So we get the percentage of ownership interest that they're identifying. If there's any debt with the DST, we get that number as well. And then we just submit that to Justin and his team, and the client signs, that ID form, and then they live beyond, day 45.
Yeah.
That can happen like this. I mean, it can happen like, in an hour, really, if we wanted to. I mean, that's how quick it can happen. You don't need to buy that interest. You don't need to close on it. It just allows us to live past day 45 and extend the time clock a bit, and then continue doing due diligence. If they want to go into the DST, they can, or, mineral rights, they can after the clock is, kind of expired, but you can't change that ID form after midnight on day 45.
Right.
The
So,
second
yeah,
question I had was the opportunity zones, and are they competitive, or they work with you, or there's a lot going on in that space as well.
Well, Justin Amos's company is not, not like Justin needs it at all, but I'll, kind of toot their horn a little bit here. I mean, they're giant, man. I mean, JTC is one of the biggest ones in the space. They've been growing like gangbusters ever since I have met Justin. So they're traded on the London Stock Exchange. They do fund admin work for DST companies, for OZ companies. I mean, they're big. So I wouldn't necessarily say it's competition. We do a lot of opportunity zone fund equity raise. So we were on the forefront of that when it came out. So if somebody's looking at an OZ, they might not be the same type of client as somebody who's looking at the DST. Like the DST is really for people that want to retire, they want to be hands off, they don't want to manage anything anymore. The OZ, it was a lot of ground up development to get the tax benefits. So ground up development just, instinctively has more risk associated with it. And you have to wait 10 years to get that step up in basis in the OZ to receive the actual tax benefits. Otherwise, it's really not worth doing it to get a couple year deferral. So it's just a completely different client. They do kind of, blur the lines a little bit. Maybe it's a little competitive here and there. Maybe, one's getting a DST when they might have went OZ or, vice versa. But I usually see really wealthy families, Nelson, like really wealthy doctors and stuff like that are still making a lot of income, looking to do estate planning, and they can wait out that 10-year mark. You're not really going to see somebody who's like 80 years old going into something like that. So it's kind of two different types of clients that we see. But that's just
Yeah,
my experience.
and to touch on that, Tommy, thanks for the plug there too. You know, I, DSCs, mineral rights are really focused for that real estate client. I mean, with opportunity zones, the capital gains that you can put into those programs is from anything. You sold
Yeah.
you sold artwork, you've sold a stock, anything that you've gotten a gain with in respective tax year, you can put the where I guess it blurs the line because you have 180 days for both to meet the requirements, for each transaction. But I would say it's a more nuanced. That being said, there is significant tax benefit within an opportunity zone program if you can wait the 10 years because the vehicle itself really kind of operates like an IRA. So, the investment, while it's in an opportunity zone, any gains or, and valuation as the investment grows is tax free, which is really nice. Or Roth IRA, sorry, and I mentioned IRA earlier. But
Tommy B,
it's definitely a really nuanced type of client, but both off, and especially now, it's been growing or picking back up again. More people are starting to get back into the opportunity zone space with the recent, favorability of, the government.
Tommy B, you want to add something?
Oh, I was just going to say that regarding the first question, Nelson, it's the short answer to your question is yes, you have to identify these properties as a line item on your identification form. Like Tommy Thompson was saying, it's just you can change it, you can swap them out leading up to the end of that 45-day ID period. But for mineral rights, you are identifying it as an individual selection. You don't get a 123 Main Street address in mineral rights. You actually get a legal description. To the layman, it will look like a mix of letters and numbers, like the Northwestern Block 7 of Southwest. You get where I'm going. So, but that's essentially the address that you identify as one of your replacement properties on that 45 ID form. Just wanted to make that clear. It does take up one of your identifications.
And Nelson, I just want to add, because of crypto, there's a different need and a different use for each one of these systems, whether it's mineral, DSTs, OZs, but talking to experts, right? And this is where I'm very fortunate listening and learning from everyone and updating because the laws change and all the new things happen. Collaboration is the key, getting knowledge and I was just thinking getting our mastermind group back together again as B2B because we talk so much of how we could work strategically and it's like a Venn diagram. We don't overlap, but if you work with good people that want to take care of their clients, they're not trying to shove them into their product only. They're like, wait, maybe an OZ does work for you because I had people doing stock, from their stock appreciation. massive millions. Crypto people, they want to diversify, massive millions, right? And they're like, oh, no, no, no. It doesn't really work in certain things. But talking to a good CPA, tax planner, estate planning, and we're putting this all together at a reasonable rate. So when you play the big game, you can do stuff. And Justin, I'm going to talk to you because as we're building this global network, man, I'm talking all over the place. Bali, Singapore, Asia, China, crazy stuff everywhere. And obviously, if you're a US citizen, right, investing and partnering that they exchange, like in
Yeah.
Dubai or in different countries, they've made tens of thousands percent. I mean, it's crazy numbers of what I'm saying.
Yeah, I mean, and again, like it's been in the tax code for over 100 years, but it's still very specialized. Not many QIs have the capabilities to do it, or the hardest part typically is usually the ability to hold in respective currencies. Because you could convert to US, then push back out to another. You can end up losing a lot of money in the deal, and so some of it's just being able to hold in whatever the domicile currency that you sold in, or potentially to reinvest in, can save ultimately millions of dollars, and obviously the complexities around the
Well,
respective.
and that's a great, with all our different groups, I'm going to have you speak at our global chamber. I just had a meeting this morning with India. As our group keeps growing and through, I would always say, trust and friendship. With everyone there, you do need to build you need to build your circle of experts. You do need to have these trusted people you can go to, right? We all know that. That's why a lot of people just reach out to me and say, Jim, who do I go to, right? Lawyer, CPAs, doctor, everyone. Just having multiple conversations, right? Like I know everyone here, I know most of the speakers, we're having what, anywhere at least 6, if 10, or sometime in a day, 20 contacts, and people were talking, learning a lot. But then building your team of expert people, and this is why we're building the Renaissance as a group and plugging in with tech. So now when it comes to referral services, learning, right? I love that, learning and updating to get good, and then finding trusted people to work with so you don't get scammed or bad things happen. We've all been there too. And people that want to pass and share the wealth, really to do what's right for your client. So if it doesn't work, yes, I'm going to lose, but hey, Tommy or Justin or Nelson, giving you the exchange, it comes back, guys. It always comes back. Think abundance, think about working together. But let's do final word. Tommy Thompson, and then the other Tommy and Justin. Tommy Thompson.
Yeah, yeah. I mean, I think we just covered some really great additional topics there. I mean, Justin Amos is the guy for foreign exchanges. That's his wheelhouse. That's a great topic. Opportunity Zone 2.0, OZ2O. That's something I'm going to be on the forefront of. That's another really great topic. You guys gotta be paying attention to that in the rural areas that they're going to be designating. I mean, that's big for you guys. So happy to chat about that. And then, Tommy also probably, IDCs, intangible drilling costs, tax benefits of investing into oil and gas and mineral rights. I don't do what Tommy does. He's a specialist there, but I know a lot about oil and gas drilling funds that have really great, income tax benefits for lowering your taxable income. It's one of the most powerful tools out there is IDCs. So those are some really great topics, Jim, if you wanted to float some of those. I put my contact info, guys, in the chat, a couple downloads. Those are all free to you guys. Feel free to click on them. Reach out to me if you have any questions. And Jim, you're the man. Thank you. Thanks for having us on.
Love
Tommy
it.
Brachey.
Yeah, a couple last words here. We play nice in the sandbox, we being the mineral rights space with DSTs. Diversification is almost always the right answer. I will hat tip to the DSTs, though. They can place debt. We technically can, but we don't. So keep that in mind. We're not in the debt servicing business, so we don't want to take it on. So if you have equity and a mix of equity and debt in an exchange, you would have the option, if you will, of placing the equity dollars into mineral rights and then the debt dollars into a DST potentially. So just keep that in mind. Another piece of it is, since mineral rights are not a security, they are real estate, you do get a high degree of control that you're allowed with mineral rights. If you wanted the 1031 out of it, you can do that. Just be mindful of the holding period and timelines and things like that. You can sell it, you can donate it, gift it, whatever. You're in control on day 0 to divest it. And you don't have to divest all of it. You can divest some. Anyway, I'll leave that point there. Generally speaking, since we did talk about cap rates on some of the other DST products, generally speaking, because keep in mind, mineral rights are not a fixed income stream, right? But generally speaking, our product in the Permian Basin, people are made whole on their acquisition between year 3.5 and year 5, generally speaking. Now it can be faster, and if it can be slower, but generally speaking, that's what you see. And then just some food for thought. We didn't mention the 1033 exchange on here, but just for a cliff notes there, that's generally eminent domain and condemnation on a property where the government's essentially seizing your assets. You can 1033 into mineral rights too. Keep me honest, Tommy. I think you can 1033 into DSTs, if I'm not mistaken.
Man, I mean, I could go down a rabbit hole on that.
Yeah.
It's so crazy. It's
Let's
so
not
crazy.
right now.
It's so crazy how many people, a lot of people don't know that when you're doing the 1033, you can, if you go into a DSC that has leverage on it, that counts towards the equity that you have to replace. So you can, if you have $1 million in eminent domain that you got back and you buy into a DST for 500,000 that has 50% leverage, you're buying $1 million of real estate. So you get to keep that additional 500,000 because the debt replaces equity as well.
That's
so
incredible.
yeah, I mean, 1033s in the DST world are huge. And I mean, if you can just follow the path of growth, right? I mean, where they're building highways and, all that stuff. And a lot of people just don't even know they can do it. So that's a great.
You're
Well, that's
exactly
going to be
right.
a part 2 with land
Yeah.
banking, IRAs, but we got to kind of move on. I'd like to stay
Understood.
on it, but thank you. But
Understood.
Justin, go ahead.
My final segment is I think 1031s is poised to have another great year in 2026. So if your clients, any way we can support you, whether it's domestically or foreign, happy to be a resource for you. Like whether it's education, prospecting on the exchange, excited to be working with you.
Yeah. And I'll leave one last thing here. Like Tommy did, I also put my contact info in the chat. If anybody wants to book time with me, I got the domain bettercalltommy.com. It'll book you a time on my calendar. So feel free to do that.
Better call Saul, huh?
It's all good, man.
Perfect, everyone. No, this is what makes it fun, right? Engagement, interaction, learning some stuff. You could always learn. I mean, I've been around, everyone knows I do a lot of talks, but I'm always learning. And that's the secret. You got to show up. You got to keep learning. So when you plug in and what we're doing to automate all this with friends, with trust, boy, we can all do really great for 2026. So join us next week for Top Agent Nation Commercial Wednesdays. And we just keep learning so we can keep earning. But let's make this a great 2026. Everyone have a great day, great week, and see everyone next week on Wednesday. Thanks so much, everyone.
Thank you, everyone.
You guys.
Take care, everybody.